Hi, good afternoon. I'm Rich Voller at Voller Commercial Real Estate. Today I'm going to talk you through a pro forma spreadsheet for a Dollar General purchase. Also, this type of property is known as single tenant net lease, STNL, or zero landlord responsibility, sometimes also called a triple net lease property. The size of this one is 13,200 square feet. You see that right there. That's pretty typical. The annual rent is 130,000. That's the base rent, and also that's the triple net rent, which because they pay all the expenses. Landlord pays no expenses. The asking price in this case is $2 million. Down here we have the first block is the rent roll. There's only one tenant, so that's fairly simple, straightforward. You go down here to see the income expense information right in this area. You have $130,000 income. You have zero expenses by the landlord. The tenant pays all of those, so you still get $130,000 a year. If you want to look at your cap rate analysis, that's in this block right here. So you start with your income again. There are no reimbursements by the tenants to you, and there are no payments from you for expenses, so you keep that 130,000 going. The vacancy is 0% because in this type of property, it's either 100% or 0%. Your net operating income, again, being overly redundant, is $130,000. And to get your cap rate over here, your capitalization rate, you divide 130,000 by your purchase price of 2 million. That gets you a rate of return of 6.5%. That's the rate of return you're getting on the cash that you invest if you buy this deal at this price. If you want to put debt on the property and look at financing, again, we'll start with the purchase price of 2 million. We'll go over here and look at the loan terms: 52% loan to value, 7% interest rate, and a 30-year amortization. So we have some closing costs that will vary from deal to deal, and that gets you a down payment of $980,000 on this one. I've calculated the interest for you at $83,030 per year. So if you want to look at your cash flow results, you're going down here, you have $130,000 net income minus your debt service. You have a cash on cash return of $46,970. So that is the absolute cash you're going to get at the end of the day after you pay the expenses, which are none, and the mortgage, which is calculated up here. So to get your return on that, you would take the $46,000 cash that you're going to get, divide it by the amount of money you put down, the $980,000. Your cash on cash return is 4.79%. Something banks want to see is this number right here. It's called a debt service coverage ratio, and that is calculated by taking the NOI 130 divided by the loan and annual interest payment, and that's a ratio of 1.57%. 1.15 is actually pretty good. So in this case, you've got a really good debt service coverage ratio. Moving over here to this block on the right, you see the ROI stack. That's the return on investment stack. This is really what I like to focus on the most. This tells the real story, not just the 4.79. There's more to the story. So there's your cash flow rate of return. The depreciation is calculated by taking the value of the real estate minus the value of the land. You cannot depreciate land, only the building. So you take that amount, the value, divided by 39 years. That gets you an amount of $38,462 per year. So to calculate your return, you take the $38,462, once again, divide that by the cash that you put down, and that gets you an after-tax return on that portion of 3.92%. I've used a factor of 5% appreciation, and that's 5% on the value of the building that you pay. So you'll see that's $100,000, which is $2 million purchase price times 5%. It's not on the loan amount, it's on the value of the building. So that gives you a lot of appreciation. And then the principal pay down number is calculated by taking the amount of the principal each year that's paid down divided by the amount of money that you invest. And this number will go up every year because as you amortize a loan, each month the payment goes more toward principal and less toward interest. So overall, you have a pretty good return stack of 14.3%. Not too bad for a single tenant net lease property with zero landlord responsibility, zero vacancy, zero headache. If you're interested in this type of property, call me for more information. You can go to my website at richvoller.com or email me at rich@voller.us. Be happy to have a consultation with you free and talk more about this type of property. Till next time, thanks for tuning in.